I don't think that they're going to peg major fiat currencies to gold, but I think basically that they use it as their accumulation. And what we see, for example, with the BRICS countries and associates, when they try to de-dollarize, they run into some frictions because they don't have the network effect that the dollar has. The dollar is not just a payment unit, it's also a very deep capital market. When you have dollars and you accumulate them, in addition to buying treasuries, you can buy, most commodities are priced in dollars, but then in addition, you can buy U.S. stocks and U.S. corporate bonds and U.S. private equity and all sorts of things like that. It's a very deep, unified capital market with pretty good rule of law by global standards. And the problem is we don't really see that as much in other countries. So China is a very big market, but they have tighter capital controls. India is a pretty big market, but not the same capital depth. Europe has a fractured capital base, so even though they have shared currency, they have different bond markets, different stock markets, different regulatory environments. And so when the BRICS are trying to kind of de-dollarize, you see things where, for example, Russia will sell a lot of things to India, accumulate a lot of rupees, and then not really know what to do with all those rupees. And you'll see, kind of different bilateral frictions like that start to build because all of those currencies are less saleable than dollars. And so one of the solutions to that is to kind of net settle in gold, which is to say we're still pricing things in fiat currencies, and a lot of the actual trade and things like that is still floating currency units. But then instead of kind of dramatically accumulating one country's bonds or one country's securities, they can accumulate gold. Or if Bitcoin gets big enough, it can step into that role as well. But basically, instead of the treasury being at the heart long term of kind of global long term savings, you can reintroduce that independent reserve asset, which is what we're seeing over the past several years with gold. I think part of it is because investors don't want to hold other major things. So they didn't want to hold bonds, they didn't want to hold cash, and so real estate's illiquid, and so that kind of leaves stocks, especially U.S. stocks, as kind of the main thing to invest in. It's been very attractive for large pools of capital, including some foreign central banks or just very large, long-term kind of pension systems. The problem is that you tend to get a lot of people on one side of the boat. So you get the whole world's kind of stuffed into U.S. capital markets. So you get a strong dollar, you get strong equity valuations, and it kind of lowers expected forward returns. If you ever get capital pulling out of the U.S., you could have a combination of declining valuations as well as declining currency. Now it's still a very strong cycle that's playing out, and some of the other kind of equity markets have kind of shot themselves in the foot. So Europe has deindustrialization, energy security issues, overregulation, so their equity market's not been very attractive. China's been letting their real estate bubble kind of slowly deflate. They also went after a lot of their major equities a few years ago. They still have tight capital controls, and so they've not been very attractive for global investors. A handful of other pockets like India, but they're not really big enough to be a competitor to the U.S. in that sense. And so it's kind of left U.S. markets as the only game in town, and particularly U.S. growth-oriented large caps is really, the Mag 7 and, a few dozen other stocks like, even things like Costco are really kind of driving a lot of that absorption of capital. And I think basically the biggest risk there is low forward returns from some of those overvalued names. It is, however, been notoriously difficult to time. It's been something I've been monitoring and concerned about for quite a while, but it's pushed past, prior instances of mean reversion. So it kind of, as we got close to kind of record capital concentration, it's only accelerated since then. So it's a challenging thing to time. But I do think in the coming years we'll probably see an apex of that trade, and then some of that can slowly unwind. So you get shrinking valuations, which means that even if earnings per share continue to increase for a lot of those big companies, you could see 5-10 years of poor stock returns as some of those valuations balance themselves out, and as some of the currencies balance themselves out. So I think that's the major risk, and one way you can kind of protect yourself is by having a little bit of global exposure, or broadening out a little bit away from that concentration. And the risk is, like the past 2 years, when those concentrated stocks have a very good period of performance, you're at risk of underperforming those assets, But then should this unwind, you'd be a little bit protected from that unwinding, most likely. So I think this is a trend that started roughly at the global financial crisis. So if you look at central bank tonnage of gold, it was declining for a number of decades. The Treasury was kind of at the heart of the system. And starting with the global financial crisis, there was a pivot where the tonnage held by central banks stopped shrinking and started to increase. And so we're 15 plus years into that trend kind of going back toward gold, at least around the margins. And then we've seen it pick up a little bit when we've seen global destabilization. So for example, when Russia invaded Ukraine, they got a large portion of their reserves frozen, which can happen when your reserves are held in a foreign country's securitization. It can be unilaterally frozen. And so gold's attractive to a lot of these central banks, including the trend of repatriation, so holding their own gold rather than merely holding gold claims at another larger country's central bank. And so that gives them protection against debasement, that gives them protection against seizure, and it's just basically a prudent thing for a lot of these countries to do if they want to retain their sovereignty, if they don't want to be fully susceptible to having their entire reserves frozen by the U.S. or by the U.S. and Europe together. And so I think that's a natural trend that a lot of these countries that aren't on the same page necessarily as the West want to have more insurance in the form of gold in their own vaults. In addition, when you look at how different pools of capital monetize, so fiat currency is very weak, it constantly loses its value, and so around the world, investors are trying to figure out what are they going to monetize instead of money, like where are they going to store value. And that goes back to your prior question of why the U.S. stock market's so expensive, is that for Americans and for a lot of the global pools of capital, they've monetized the S&P 500 and the NASDAQ. They've said that that's one of the highest quality assets I want to own is large cap U.S. stocks. In a lot of other countries, it's not their equity market that is monetized, but rather their real estate market. So Canada, Australia, much of Europe, China, many emerging markets, you'll see a lot of monetization of the real estate. And so while the U.S. stock market arguably has bubble-like characteristics with the valuations and the capital concentration, you see the opposite in a lot of other countries. So, Canada, Australia, Europe, they don't have very expensive stock markets, but they do generally have very expensive housing markets. That's where they've chosen to invest their long-term savings. And especially in the East, as we see China's property bubble, deflate, I think gold steps back in as an attractive thing for them to own if they don't want to own foreign securities. If they run into capital controls, if they even if they want to have foreign securities, one of the socially acceptable investments for China, India, and elsewhere is gold. And Americans, I think, in general, are often complacent around currency. Americans haven't really seen currency crisis in their lifetime. The closest thing for some older Americans would be the 70s if they were adults during that period. But even then, that wasn't at the scale that you see in other countries. And so a lot of other countries, people have a more direct memory and therefore maybe a more tangible appreciation of gold. And for context, I just got back. I was in Egypt for 2 months. I go there every year. My second home is there. And right now, they're dealing with officially 24% inflation. And no one's really talking about it. They're down from 38% official inflation in 2023. And, they're talking about, the economy's weak, the struggles that they're facing. But that's just kind of a normal thing for them. So Egypt's one of those countries that has avoided hyperinflation in our lifetimes. But if you go back to the 60s, the data that I see available, they've averaged low double-digit inflation throughout that time. 10-15% inflation is pretty normal. Occasionally spikes higher, occasionally periods of lower. And there are billions of people around the world that live in those types of circumstances, or at least have had a major devaluation at one point in their lives, if not continuous smaller devaluations. And so I think outside of America, gold's a little bit more appreciated because they don't have the attractive capital markets that the United States has. They don't, their equities are not as diverse, not as stable, not as attractive auditing. All the details are down the road, or maybe more capital controls. And so gold and real estate have generally been the stronger focus in a lot of other countries. I would put it somewhere mid-cycle in terms of cycles that it normally goes through. That's not to say that its cycle pattern cannot change. So this is about the fifth cycle. not a giant sample size. We've done some research on this. We generally find one of the biggest correlations with Bitcoin is global liquidity. So whenever you have global broad money supply increasing pretty rapidly, that tends to be a pretty good environment for Bitcoin. A lot of other assets too, but Bitcoin has, in our analysis, one of the strongest correlations with liquidity. And then Bitcoin also has various kind of valuation measures you can look at. One of the ones I like to look at is the MVRV ratio, so market value to realized value. And the realized value in this context is basically the on-chain cost basis. So one thing you can do with Bitcoin is you can look at every coin when it last moved and look at the price that it last moved. And that's generally when people bought Bitcoin and they took it off the exchange, put it into cold storage, and you can say, okay, what price was that? And you can aggregate that for the whole network. And during major bull markets, the market capitalization tends to increase a lot faster than the cost basis. And so when you get to a historically high multiple, that portends risk for the next several years. That you're greater risk of a multi-year correction rather than just a multi-week or multi-month correction. And by that metric, we're not at the prior highs of that ratio that we've seen in prior euphoric bull markets. We're at kind of a mid-level point where multi-month corrections are commonplace for that metric to cool off. But we're not really at one of those extreme bubble highs like you see in 2021, 2017, and some of the prior ones. So I think by that metric, we still probably have more to go after some period of correction.